The markets are fairly red right across the board, not something we've seen in quite some time. We're talking the semiconductor space, companies like Nvidia down 3 to 4%, AMD down more than 5%, Micron Technology another down day, today 5%. But actually, under the spotlight, we want to uncover Amazon Mag 7 down 7%. What is the reason, and is this now a good time to consider adding for the longer term? Worth also flagging that one of the reasons why we're seeing a broader sell-off across the market is that the tariffs are now in place for those countries that didn't come to an agreement, and that's also reflected in the investor sentiment, which has scaled back quite significantly. It was just a few weeks ago we were in extreme greed, felt like we were in greed for a very long time. Now we're sitting at the back end of neutral, and if we take a look, earnings season, yes, volatility is in fact something expected, but we've seen quite a lot, and today, as we've highlighted, Amazon is under the spotlight. Now, just looking at the headlines, very strong, huge beat on the EPS by 27%. It's also up 33% from the same quarter last year, and another beat on the revenue, very consistent, 3%. That's also up double digit from last year. As always, for some of these companies in the Mag 7, Wall Street like to look at a few other metrics. We have AWS, where in fact they did outperform, just under 31 billion, expectation of 30.8, and we also see the advertising segment looking good, stronger than expected, with their sales growing faster, up 13%, when last year it was an increase of 10%, and we can also see in terms of where they expect operating income to be, 15.5 billion to 20.5, another reason for the drop. Analysts wanted to see at least in the midpoint a lot higher, 19.5. So a few reasons and a few more that we'll get onto as to why the market is disappointed. But just dissecting their earnings for a quick second, we can see revenue up 13% year on year. AWS, whilst it is very strong, up 17%, is actually one of the slower growers in the cloud space, as we will compare to shortly, and also worth highlighting, they are for the time being the market leader. As always, we love to see efficiencies across the board. Gross margin up 2 percentage points, 1 on the operating side and another 2 on the bottom line net income. The other thing that's very important to flag, especially with Amazon, yes, others in the Mag 7 are spending a lot on CAPEX. In fact, Amazon, reason why we're flagging, it is the most out of every single company. They called it not too long ago a once-in-a-lifetime opportunity, and investors will be expecting to see a return on this cash that is being spent. But as far as AWS goes, yes, they did beat in terms of the top line revenue, but what you can see is the margins are contracting, 39% down to 33%. You could argue this is as a result of the competition from the likes of Microsoft and Google, but as we can see here, they are now the slowest grower in the cloud space, 17% this quarter. We saw Google phenomenal, 32%. In fact, Microsoft just days ago reporting 39%. So perhaps the market is also getting a little bit worried. We're seeing growth slow down as well as margins compressing, but nonetheless, they are still growing. They reported just under 31 billion this quarter, which going back to 2019 is growth of 23% year on year, and advertising looking strong as well, around 16 billion, although we can see it is a little bit choppy. We're not getting consistent growth over the longer term. Nonetheless, when we zoom out year on year, we're talking 27% compounded annually. Now, whilst we won't get into this, another reason why we saw the share price drop, when the CEO was asked about AWS, they didn't really answer the question as to how investors wanted to hear. Getting straight to it, you can read this, but another thing that investors were left disappointed in. And ultimately, we are seeing this down around 6 to 7%. It was as much as around 8 to 9, so we are seeing investors stepping in to effectively buy the dip. But when we look at this company, strong performance, 17% up on the year. They're pretty much flat now year to date, so they've underperformed, as we'll come to show you, both S&P and the QQQ. And over the last 10 years, still holding true outperformance of the S&P, up 741%. still trading at the upper end of the 52-week range, where we in fact see all-time highs, $243, strong buy from Wall Street, strong buy from Quant, and Seeking Alpha with a buy. They also believe this is one to seriously consider in the portfolio. Now if we get to valuation, they do get a D. Purely on a forward P basis, they're trading well above the sector. You are paying a 118% premium. In fact, against their own 5-year average, you're getting a 78% discount, something very consistently noted when we look at a lot of metrics, trading at a discount to their own 5-year, but at quite a premium to the overall sector. Now we've said it many times, in fact, the whole S&P itself, if we just generalize it, for the large part in fact, is trading overvalued. You have Amazon now with the drop trading below 30 on a forward P. Nonetheless, it still does look to be overvalued if we're just solely looking at valuation. If we then move to a PEG basis, based on earnings growth, whilst again a lot of red across the board, you can see Amazon looking a little bit more favorably. It is now below 2. Again, will come down to a lot of factors. Valuation is just one aspect, but when incorporating growth, it doesn't look to be as overvalued as perhaps other metrics. In terms of what they expect moving forwards, well, only 2 of the next 4 quarters to be growth, 100% track record, 4 out of 4 beats, fairly sizable at that as well, and their growth grade also impressive at an A-, year on year, and expected this year consistent around the 10% mark, which whilst above the low single digit of the sector overall, does come below how they were doing historically. In fact, 5-year average, this company was growing faster. Also holds true to EPS, where its projected growth 18% over the next 3 to 5 years, above the sector at 10, but slower than historicals of just below 30. Now in terms of profitability, we get an A+, where gross margin 49% is above the sector at 38 and their own 5-year, so we're seeing efficiencies, always great to note, and bottom line 10%, likewise above both sector and their 5-year, so not only is Amazon increasing their top line revenue, but in fact they're also improving on those margins. Cash as well that's generated continues to increase at a rapid rate, 114 billion on a trailing 12 month, well above the sector in the millions, and in fact significantly higher than their own historical 69 billion. So quick recap, we get a double strong buy from Wall Street and Quant with a buy from Seeking Alpha, D on valuation, A- on growth with an A+ on profitability. Now what are the institutions doing with their 72% ownership? They sold 70 billion in the last year. They've bought just over twice as much at 180 billion, and we've also noticed in the most recent quarter significantly buying 33 billion versus 3.3 billion selling. Clear and obvious, net buyers extremely bullish, and if you want to see the reversal of this trend, where in fact they sold more than buying by just a small amount, in fact it is Q4 2022. Likewise, if we do the same but specifically looking at insiders, 10% ownership with around 7 billion being sold in just the last year, 5 of that in fact in Q3, so we're just talking over a month. Remember though, as always, insider selling isn't what we typically would call bearish signal. They sell for many reasons, personal, financial, and perhaps even a wedding. We can see the most recent one, 24th of July, Bezos, in fact, he's the only one that has been selling, at least in the recent period. In fact, in totality, as we saw, we're talking in the billions. We also like for consistency to see what super investors are doing. And in fact, when we look at all super investors, we can see that Amazon is one of the most held stocks. In fact, we can see 24 of them having this in their portfolio. That same number alongside Visa. And whilst they haven't all come in, this latest 13F filing, something we're expecting in the next few weeks. So make sure you are subscribed, notification bell is on so you are made aware. Those that have come in, we're talking very trivial movements, a very slight trim, and a very slight add. One thing that is consistent is that analysts continue to raise the price target of the company. We have UBS calling this a $271 stock. We have another analyst putting this in the $262 region. And we also have Morgan Stanley, who actually believe Amazon intrinsically sits at $300. Something a lot of them all see in agreement is that the tariff effect is likely not to be as large as expected for the company. And we'll also just zoom through some of their investor slides. On a trailing 12 month, their revenue is up 11% year on year, their operating income up a massive 40%, and bottom line up 59%. But one thing we have to make you aware of is that their free cash flow, at least on a trailing 12 month, has been decreasing, and the main culprit of this is the amount they're spending on capital expenditure. As we can see, it's only increasing very significantly, while in fact we are seeing operating cash flow increase. That is taking a hit, hence why we are seeing the declining nature in free cash flow every single quarter. Worth highlighting though, Amazon isn't a company that does share buybacks. They don't in fact give out dividends. They use all of that cash flow pretty much on capital expenditures, especially now with AI at the forefront of their mission. And as we said, shares outstanding has only been increasing. They continue to dilute your position as a shareholder. Now we'll also reflect on some of the underlying metrics like free cash flow. As always, we want to see consistent growth over the longer term. We get that up until 2024, but due to the ramping of CAPEX, it is estimated to drop in the next 12 months to $268 per share. Sales growth for the large part does look strong, nearly double digit every single year, 11% in 2024, projected around the 10% in 2025, and we'll get onto these sales very shortly, but you can already see very strong growth over 6 times in the last 10 years. As we highlighted, diluting your position as a shareholder. Bear in mind though, if they do outperform and continue to do so, maybe not a massive worry. ROIC, one of our favorite metrics at 10% or more, just to give us faith management are able to effectively allocate their capital. Pretty inconsistent, but good to see 12% in 24, 13 on a trailing 12-month basis. And margins, we already compared it to the sector and in fact their own 5-year, which was very good to see improvements on. They're also showing here efficiencies, operating margin 2% 10 years ago, now sitting at 11%, and free cash flow for the large part around the 5% minimum we want to see every single year. Finally, net debt to EBITDA, highlighting the strength of the balance sheet. One thing we want to say is typically we want below 3, ideally below 1.5. These are the number of years it would take the company to pay off all of their debt net of cash on hand. 0.24 on a trailing 12 month, expected to go lower over the next 12, signaling to us a fairly strong balance sheet, something we love to see. Now we discussed comparing their performance against the S&P and the QQQ. As we've already said, pretty much flat year to date, S&P up 8, QQQ up 9%. When we zoom out to the last year, they go from underperforming to outperforming on both accounts, 25 versus 15 and 22. And if we zoom out to the last 5 years, very interesting to see how this continues to fluctuate. They've underperformed both S&P and QQ, 41%, S&P 94, QQQ 114. But actually, when we zoom out even further, you can see how this changed depending on how long you've held the company. They've outperformed quite significantly, 742 versus 206 and 453. But as always, remember, past performance is not an indicator of the future. Now we're just going to run through both income statement and balance sheet before we get to our valuation. But as we said, revenue pretty much 6 times over the last 10 years. But what we want to identify here is, what does the bottom line net income tell us? Is it a fairly consistent story? For the large part, we do see that. The answer is yes, going from 600 million reported 10 years ago to now sitting at 60 billion in the latest annual accounts. Trailing 12 month looking good as well at 66 billion. And the other thing is their balance sheet quick health check, cash versus total debt, where we see cash go from 20 billion to now sitting at 95. As always, one number here in isolation will give nothing away, so we compare it to their total debt numerically and directionally, which, similar to cash, has been increasing. 18 billion, now sitting at 158, very rapid rise, but what we would say is net debt to EBITDA sitting around 0.2, 0.3, doesn't look bad for now. As always, something to keep an eye on. And before we look at the valuation, just to let you know, we have released our latest free weekly article. We draw on every single Monday morning where we cover severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away. And make sure you are subscribed, because tomorrow we will be releasing August's edition of severely undervalued stocks. Lots of information as always, the upside that Wall Street themselves see over the next year. And you can also grab a recently released copy of stocks that Wall Street believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. Now getting to our valuation, we get to $228 derived from the DCF model. Now what we have here is their free cash flow year on year. It was up 4% in 2024. Now we've gone for 20% moving forwards. As you can see, low, medium and high, 15, 20, 25. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Amazon or any others. But based on the growth rate and the discount rate, we get the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we get to 228, indicating 6% upside. Now you could believe that is too high, you want to be more conservative. We'll show you as well, for transparency, 15%, 160, downside of 26, and at 25, 323, 50% upside. Now as always, we do take through the middle rate of 20%. We do want to flag though, based on a reverse DCF, already baked into the numbers right now is 19.1% growth year on year. So if you believe it should be higher, then in fact you see it as undervalued. If you believe this is way too high, it should be lower, then you see this as overvalued. Now we don't stop there, because we always use a margin of safety, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, buy at $206. However, it isn't quite there yet, so no 10% MOS. At 5% is pretty much where we see Amazon now. As we've already flagged, analysts have been increasing their price targets, but on average it sits at $260, indicating 21% upside. Now for consistency, we'll show you at 10% a buy at 206, at 20% a buy at 183, and at 25, 171. Amazon today, 5% MOS, 21% upside. Give us your thoughts. Is now the time to buy this strong earnings dip? Or in fact, did you see the earnings? Bit worrying. We got AWS margins being compressed. We also saw the operating income not to the standards that Wall Street wanted, as well as a few other bits. As always, in your view right now, Amazon buy, hold or avoid. And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us on Patreon where we run through our buys and sells. And as always, have a great day. We'll see you all on the next one.